Hey everybody, it's Larry Berman here. Normally this time of year I get really excited about NFL football, Thanksgiving week in the US, the beginning of holiday season. But I got to tell you, my Buffalo Bills are just stinking out the joint. Years ago, early 90s, I was a big Bills fan, and we had a great team. And I moved to Boston in the mid 90s for work, and I became a Patriots fan. And in the last couple of years, I've come back to the Bills when Brady left the Patriots. And last year was looking really good. This year, not so much. Anyways, markets are difficult. I get into these periods of time where I'm just not quite in sync with what the market's doing. And that's been the case for a couple of weeks now. We had a strong expectation of a hard landing. Still do. That hasn't gone away. But the data we have and the policies that the Treasury implemented in terms of supply of coupons relative to bills has really changed the short-term dynamic. So let's take a look into the chart room and see what we learned this week. So we got a Goldilocks kind of week when you look at inflation expectations and the actual numbers. When we look at retail sales, everything was kind of Goldilocks. And the narrative out of Wall Street changed dramatically. I mean, it's almost universally expected. It certainly isn't universally expected, but it's almost universally expected now that the Fed has done the job and we've got this perfect looking economy coming. And it's all predicated on recency bias. What was the last data point we saw? And so this week, that last data point was really friendly for assets. And of course, we had another big, strong week in the stock market and in the bond market. When we look at long-term inflation expectations, so this is the graphic of the five-year inflation swap. And again, that's the expectation of 5-year inflation 5 years from today. And in the last few years, we've definitely seen a significant uptick, obviously from the COVID depression, but really of the last, let's say when oil broke here in the fracking revolution, we haven't yet quite achieved the $100 oil type inflation expectations, but we're creeping up there. And I think that trend is more likely to continue. We did hear out of Walmart and Target this week the word deflation, and the changing behavior in consumer patterns. So here's what doesn't add up in the soft landing. If the consumer's really getting stressed and changing their spending behaviors before they've actually lost their jobs and got laid off, that to me tells you how stressed the consumer is. If that's the case, to me, more of a hard landing, the stock market shouldn't be celebrating rate cuts. It all is levered off of inflation and inflation expectations. So the recency bias in the data has convinced people that inflation's not going to be a problem anymore. And now they're aggressively pricing in rate hikes. We heard from several Fed speakers this week. They all try to walk it back a little bit and said rate hikes still on the table, yet financial conditions remain pretty easy. The big beneficiary of easier financial conditions is seen in the long duration assets, otherwise known as the NASDAQ. All will know, they probably heard if they're paying attention to markets this week, 40% of the Russell 2000 doesn't make any money when the economy's booming. So, but what was the biggest risk on, rally this week other than large cap tech, which we saw there? Saw the gap there following the inflation numbers. We're now back against this resistance that we saw earlier this year. And we're only within a couple of points of the all-time highs from 2021, which is mind-numbing considering we haven't had any economic fallout whatsoever in the fastest tightening cycle that we have ever seen in history. Put IWM here in, which is the Russell 2000, again, the basket of non-profitable companies, and you see something very, very different. So while we got a bit of a risk-on bounce this week, we're nowhere near recent highs, and we're certainly nowhere near any peaks from last year or from 2021, right? Like, we're not close from that perspective. So if the economy was really strong and small caps were really, so it's still very much a defensive, chasing the names, chasing the performance, and the ones that have been winning so far this week. So we got the last of the big name finally reporting this week after market on Tuesday. What this chart shows us is the analyst consensus target. So Nvidia right now, the analyst consensus is about 650. We're sitting and we're going into that pretty much at the all-time high for the stock. Having said that, we added a small position to our portfolio a couple weeks back by covering some puts and exposing our portfolio to the long side and covering some covered calls we had put on back here to expose us to the long side. So on Friday, I had a 485 call. I sold that long position out. And what I did on the options side of things was that I wrote a 1 week. So these are the 1 week options, are Nvidia. I wrote so I sold it at 465 plus the premium I earned. 485 plus the premium I earned. I wrote 465 puts late on Friday for 770. Last trade was 765. The volume was pretty decent today on that strike. A lot of these option players talk about, gamma walls. So if you think about where this stock will gap to on good news and bad news, it would appear to me that right around this point is not a bad point, that if I sold it today to buy it back Tuesday, otherwise I take in next week, that's $7.70, not quite 2% profit from where I am now in a couple of trading days. So I like that trade. If the stock gaps to the upside, here's what I'm looking at doing out into June of next year. So the 1 year price target is 650. So if we look at the June calls next year and we blow this out and we look at the call side only and we look at the full spectrum of the call side only, we see that a 550 call, again, roughly where that price target is, today trades for $51. If the news is great on Nvidia, it wouldn't surprise me for the stock to gap up another $20, $25, $30. It's done that before, so that could be. I want to be a seller into that, and I'm looking to sell this 550 call. So if we gap up $20 next week, I think if we go back to, let me do this here so I can give you a sense of what this thing might be priced at. Going out to June next year, I'm going to put in a 520 price gap in there. And we're going to put the strike up to 550. And that 550 would trade at $65. So that's basically, you're selling the stock at by $615 break even. I think that's a massive sell up there. So that's kind of what I'm looking at to play Nvidia this week. I don't know where the chips are going to fall, so to speak, on the earnings report. Obviously, the trend there is good. We did hear that one of the main guys behind OpenAI was let go by Microsoft. I haven't dug into the total details on that yet, but when that headline hit late in the trading day, we saw tech come off a little bit. Whether it was related to that headline or not is hard to say, but thought that was pretty interesting. Another area on the interest-sensitive side. So this is Vornado REIT. We talked about this months ago when it was trading in the $15, $17 area. It bottomed out, you could see at 1231 low. In Q1, it was 1250 low, in Q2, 1231 low. We commented at the time that it was trading at similar valuations not seen since the mid-1990s. Prime A, New York real estate, very, very attractive. These guys cut their dividend. They're preserving cash. They don't report for a couple of months. Short term this week, I wrote a $25 call for January because I think I can earn that 4% premium there without much risk. And if it's at 25, I'm happy being short that. I was at a real estate symposium this week, and one of the guys says, I love office. There's a lot of pain coming to office. And as an opportunistic, cash-rich buyer, we're looking in that area to be a big buyer. And I don't disagree with that sentiment. It's just that right now, coming off the lows of last year, they're pricing in an awful lot of good news in the short run, again, with a lot more pain to come. If you can pick up Vornado REIT below $15 or $17 some point in the next year or two, I think it's very, very attractive and compelling from a long-term perspective. It's going to take years before office space is full again, but you can believe office space is going to be full in Manhattan in the long run. So very, very interesting play here. I'd put it on your radar. I wouldn't touch it here, but you can start writing calls out to puts out to mid next year and earn some pretty nice premiums in those names while you wait to own them. Anyways, that's all I have this week. Happy Thanksgiving to our U.S. friends, and look forward to a pretty exciting end to the year for equity markets, where we're likely to get a lot of two-way volatility ahead of us.